Hello, I'm Jack Holmes, Chief Investment Officer at Bridges Trust. Thanks for joining us for another edition of Take Stock, where we discuss the market trends, economic developments, and investment themes shaping today's environment. Today I'm joined by two of my colleagues, Sarah Murray, Vice President of Investment Solutions, and Connor Pugno, Portfolio Manager. To kick things off, let's start with what we see as the biggest driver of market strength this year, and that's corporate earnings. So coming into the year, analysts were expecting 15% earnings growth for the S&P 500, which is well above average. And at mid-year, those estimates have climbed to north of 25%, which is really extraordinary, nothing we've seen for a very long time, certainly in a non-recessionary period. So looking ahead, they're actually expecting next year to be also very strong, 20% plus earnings growth. And so that's a very strong fundamental backdrop for the equity market. However, these earnings gains haven't been evenly distributed. Much of the upward revisions have come from a relatively small group of companies, creating significant performance differences across the market, particularly within the technology sector. So Connor, what do you see driving this unusually wide performance gap within the technology sector, and how do we expect that to evolve moving forward?
Yeah, thanks, Jack. And I think, like you said, it's been really pronounced over the last year. The market and investors have really anchored to this idea of perceived certainty over the next few years, where semiconductor companies and equipment are seen as the largest beneficiaries of a lot of this AI infrastructure spending. Now, that's come at the expense of a lot of software businesses, which are seeing more and more disruption or potential disruption to their business models. Historically, they were able to spend a lot up front and then generate increasing returns and margins over time through selling into an expanding installed base. But that moat and those competitive advantages look more and more uncertain today, which is why the market and investors are penalizing software and bidding up and increasing expected returns for the AI infrastructure beneficiaries instead. And that's what you're seeing in this chart in terms of that bifurcation over the last year.
That's helpful. Staying within technology, AI infrastructure spending has been one of the biggest stories this year, and you alluded to that. But how should investors think about elevated capital spending, both in terms of the companies that are benefiting today and the hyperscalers that are making those investments?
Definitely. I think this chart does a really good job of showing what's going on under the surface. The hyperscalers or the Amazons, Googles, Metas, Microsofts of the world are the ones that are spending an increasing amount of their capital on this infrastructure to build out data centers and AI capabilities down the road that should bear fruit, but the market is still questioning whether or not those will show the types of returns that the companies are hoping to produce. And what's happening is a lot of that cash flow is benefiting the semiconductor equipment industry and the supply chain and the bottlenecks that are popping up throughout that supply chain. And you can see this chart diverge really quickly within the last year to show a lot of that cash flow benefiting the equipment side while hurting or producing even negative cash flow for the hyperscalers that are spending more and more to potentially capture a really attractive opportunity.
Thanks, Connor. Sarah, shifting beyond megacap technology, we started to see a broadening of market participation this year. What's driving that improved performance for mid and small cap stocks, and is this trend sustainable?
We see this as a really positive sign for the start of the year here. As this broadening in leadership, you can see on the screen that small cap companies have actually outperformed all of the other domestic large cap, mid cap companies here year to date. This is usually a sign of a healthier backdrop for long-term investors. And really what's driving this is the underlying earnings. In recent years, small cap earnings have been lowered throughout the year. But year to date here in 2026, we have seen small cap earnings continue to stay strong throughout the year instead of being lowered. And that really the market is giving credit to those small cap companies where earnings is coming through.
Thanks, Sarah. So finally, as we updated our capital market expectations at mid-year, what changed the most? And I'm sure this is on top of investors' minds, but markets are near all-time highs. So how should we think about expected returns moving forward over the next 5 years?
Yes, thanks, Jack. It's a very important point, especially with markets where they are today. It's really an earnings story, and until you started this little segment here with understanding what's happening below the surface, when we meet as a CME team, we truly develop fundamentally based forward return expectations. And as you can see on the screen, large, mid, small, and international equities have all kind of converged to the same expected forward return, which means large cap companies today actually still provide a good entry point here and a good forward return expectation, really due to our increasing those forward earnings numbers on the large cap side.
Very helpful. Sarah and Connor, thanks for being here today and sharing your perspectives, and thank you to everyone for watching. We appreciate you joining us, and we look forward to seeing you on the next episode of Take Stock.